The new 2018 tax law has been with us for over a year now, but many taxpayers are only seeing the differences now during the 2019 filing season. Many are finding that their refunds are smaller than in past years, and some are upset. The reality, though, is that receiving a refund is what you should be upset about. Tax refunds are not a good thing. I'll show you why coming up next. Every April in the United States, families file their tax returns and eagerly begin awaiting their tax refunds. That's where the debating begins. Do we buy a new TV? How about a vacation? Maybe we should invest the money for college. But really, we shouldn't be happy about receiving a tax refund. In fact, we should all be working with our HR departments to reduce the amount of our tax refund every year. To understand why, you need to understand a little bit about how income taxes work. Income taxes are owed on all earned income, whether those earnings come from work, self-employment, or investments. But no one pays taxes on all of their earnings. You can reduce your taxable income by subtracting out various deductions. Look at this example. This couple makes a combined income of $100,000. Tax liability based on 2018 rates equals $13,800. But every couple receives a standard deduction of $24,000. So automatically that reduces their liability down to $8,700. They may even qualify for additional deductions if they were making payments to a mortgage, giving money to a charity, or paying for college expenses, just to name a few. Each deduction reduces their tax liability even more. Whatever your tax liability, you are responsible for paying a minimum of 90% of it slowly over the course of the year. For most of us, that means we let our bosses take care of it through automatic paycheck withholdings. Those withholdings are taken from each paycheck and sent directly to the IRS on our behalf. Here's the challenge. You don't know what your final tax liability is going to be until you file the following April, because you don't know what your deductions are going to be. Your boss doesn't know what your tax liability is going to be either. The amount of each withholding is just a guess based on your income. If your boss's guess leads to his withholding too much, then the IRS will refund the overpayment come April. If too little is withheld, then you'll end up paying. But none of this changes your actual tax liability. The point here is if you end up with a refund, it simply means you paid too much during the year. It also means that the government has had a portion of your paycheck for use for free for up to a year. That's not something to be happy about. So if you typically get large refunds, what do you do about it? You can work with your HR department to lower your per paycheck withholding. Tell them how much you want to reduce your annual withholding by, and they should be able to help you fill out the correct paperwork. Your goal should be to break even. Remember, you don't want to reduce your withholding so much that you end up owing a lot come April. In fact, if you pay too little, you could end up paying a penalty. Here's an example. If your tax liability for the year is $10,000, remember, you are required to pay 90% of that, or $9,000 during the year. Let's say you only paid $8,000. You will owe $2,000 with your April filing, but $1,000 of that would be subject to underpayment penalty. The formula for calculating the penalty is complex, but it's safe to say that it will likely be about 3.6% of the underpayment amount, or about $36 in this example. Please subscribe to my channel. I'll be releasing more videos weekly covering financial planning, investing, taxes, and insurance. You can also visit my blog at smartzonefinance.com for more financial insights. If you would like to see your financial question answered as an animated video, feel free to leave a comment below.